quick look at the difference between financial accounting and management accounting. Financial accounting is different from management accounting, and our software platform clextra is much more focused on management accounting, but you also need to have your financial accounting in place. So therefore you would like to draw the distinction between these two systems. So in financial accounting, the audience is external stockholders, creditors, and tax authorities. The purpose of financial accounting is to report on past performance to external parties, contracts with owners and lenders. Timeliness is always delayed and historical. Typically, you'd have it as of March 31st, data in the last 3 months, last quarter. That's the timeliness. Restrictions, regulated rules driven by general accepted accounting principles in government. It's essentially to report to government and tax authorities in a standardized way. So statutory compliance is what it's all about. Type of information is usually limited to financial metrics and numbers and measures, financial measurement only. The nature of information is objective, auditable, reliable, consistent, precise. It's numbers, only numbers, and not opinions and the intangibles. It's all about tangibles. The scope is highly aggregate, report on entire organization. It can be all of the balance sheets, financial accounting, profit and loss, ledgers, everything comes under financial accounting. There could be variations and debates about how things are costed, for example, activity-based costing versus uh, project costing, process costing. There could be, but all of that still comes under financial accounting. Now let's look at management accounting. The audience is internal workers, managers, and executives. It is to help you operate your business. The purpose is to inform internal decisions made by employees, managers, feedback, and control on operating performance. Timeliness is current and future oriented. So the idea is to be able to plan ahead, cash flows, um, most what happens next and in the future. Even in terms of the financial planning, budgeting, what are you going to do the following year really falls much more into management accounting. Whether the budgeting has been adhered to, the actuals would come into financial accounting, but the budget itself could fall into management accounting. So the restrictions, there are no regulation systems and information. So it's quite open-ended in terms of what is needed. It could be tangible information, intangible information. So there's no limit to what it is. We use the balanced scorecard method. We'll be discussing this subsequently and separately, which uses 4 different perspectives, financial accounting being one of them, but there are 3 others. Then the type of information is operational and physical measurements on processes, technology, suppliers, customers, and companies. So tangible and intangible information can be brought in. Futuristic. The nature of information is much more subjective and judgmental. Risk management can play a huge part in management accounting, where you're looking at the risk mitigation, the likelihood, the probability, and being able to take informed decisions on a quality risk management program. Likewise, whether compliance, governance, likelihood of compliance taking place, governance issues, will it be governed, so even governance and compliance issues can be brought into management accounting. The scope, so disaggregation, drill down information on local decisions and actions. So you can look at quality of decisions. We have in clextra, we have a range of options to support the scope for drill downs, disaggregation, aligning processes, SOPs, and metrics and measures into job roles, performance appraisal, skill sets. So our management accounting extends widely and vastly across the enterprise, and we have the tool and cloud platform for this. So that in a nutshell is the difference between financial accounting and management accounting as we see it today.